Hello and welcome to our latest episode of Advance Your Wealth. I'm Homer Smith, Private Wealth Advisor at Convergent Wealth Partners. Today we're going to be going over our February 2022 market and economic update. And we're going to be covering quite a bit on the call today. Obviously, the big thing on so many people's mind is what's going on in Russia with the invasion of Ukraine and how is that impacting the markets and the economy. And so as we go through our February market updates, we're going to touch on those impacts as well as how we see it impacting the economy over the long run. And also, the importance of having a good defense with a good offense, specifically for times like these. Before I dive in, obviously, just want to recognize just the challenges for those in Ukraine and what's going on out there, and just recognizing that these are tough times, and we are obviously very concerned about everybody, their families in that area, and we're going to do our best to keep you updated on what we see happening, and again how it impacts the markets, economy, your portfolio, and all of that. So you should have seen in the last couple of weeks regular communications coming from us on what we're seeing happening in the updates, and today is more of a summary of what we've seen over the last month or so. So just to dive in, with that volatility coming from the invasion of Ukraine by Russia, we saw, especially near the end of the month, a bit of dip in the markets with a little bit of a recovery right at the end, but we still saw the major indexes, the S&P 500 and the NASDAQ, both down around 3% on the month, a little bit over 3%. However, we did see some outperformance in the small caps in the Russell 2000, which had been underperforming over the last few months up until that point, and had a bit more of an outperformance. And what we've seen though, I'm shooting this in the first week of March at the end of the week here, and we've seen obviously a lot more volatility since these charts were finalized. And global markets obviously were not a safe haven either, and even worse so far in this first part of March. What the markets in the U.S. down around 3%, global markets were down about 2.5% on the month. However, not all areas of the market were down. We did see a large rise in the value of commodities. Obviously, this is an implication of some of the restrictions that were put on Russia from the fallout of the invasion. So a lot more sanctions around their oil and their financial markets, and that has led to significant increases in commodities. So the commodity index itself was up about 5.5% on the month. And when we look at Commodity Trend Advisors, which is one of the ways that we can access the performance of commodities, they also had really, really strong months of February as well. And so this is one of the key asset classes that historically has done extremely well in an inflationary environment, which we're also seeing even ahead of the invasion of Ukraine, and that we expect to continue here in the near future. Another area that's done extremely well over the last couple of months as part of this uncertainty that's been going on is gold. And so the gold index was up almost 6% in February, and like commodities has only continued to move to the upside over the last week or so in this first part of March. Another area that typically is a safe haven for volatile times is the bond market. However, what we've seen most of the last year or so is a steady rise in interest rates, and to the point of in mid-February, those rates got over 2% for the first time in quite a while, and it wasn't really until the clear invasion of Ukraine and the fallout from that near the end of the month that we saw those rates retreat back down a little bit. As of this week, this first week of March, they're even closer to more like 1.7 right now, but got back down to 1.83 at the end of the month. So that's the main areas that, from an index perspective, one of the biggest stories that you all have probably heard quite a bit about and you're experiencing, in your own pocketbooks is the rapid rise in the price of oil. So at the end of February, the price of WTI crude oil hit $100 for the first time in a very long time and has continued to go up this week. And this is going to be something that impacts a lot of different areas over the long run. So we've all been hoping inflation begins to come down again and hoping that we'd see some relief at the pumps. And this invasion of Ukraine and the sanctions on Russia have only exacerbated the issues with oil continuing to go up and spike in prices here in the recent couple of weeks. And as would be expected, these rise in sanctions and obviously a ground war in a country is going to have significant impacts on those local markets. And you can see significant declines in the Ukrainian and Russian stock markets, and that's only accelerated again in this last week as we're shooting this video in the first week of March. So those were the key market updates, and obviously there's a lot of changing, a lot of moving pieces going very fast with everything going on out there. But I think one thing we really wanted to focus on in this video as well is that while the conflict in Ukraine that is impacting the headlines every day is important, and especially with the price of oil and a lot of the commodities and food commodities in particular, it's not the only story going on out there related to some of the challenges we face ahead in our economy. And so we want to touch on a lot of the economic indicators as well. And two of the most important ones that we focus on are GDP and inflation. And so with everything going on, GDP, even from our most recent update at the end of January, our GDP expectations continue to come down. And a lot of that is related to continuing higher oil prices. And if you think about how that impacts the economy, higher oil prices leads to higher gas prices, which means most people, especially lower income people, are having to use most or more of their income just to have daily transportation and heating, and less of that can go on to other things, spending, saving, and the like. And so our GDP expectations continue to fall in terms of what we're expecting for later this year. It's not into recessionary areas yet in terms of the predictions, but the longer that higher oil sticks around, the bigger risk that becomes. Same story on inflation. While we do continue to expect to see inflation slow in terms of the rate of change over the course of the rest of this year, our numbers continue to move higher again in terms of our expectations for the near-term future quarters because of higher oil prices, higher commodity prices that are persistent, and again spiked because of this Russia-Ukraine conflict. We're anticipating that inflation is going to be sticking around at much higher levels for much longer periods of time. And related to all of this is around the inflation conversation in particular, is there's been high expectations that we're finally going to see some Fed rate hikes this year over the course of the year. And it got to the point, because of some of these inflation numbers, where the number of rate hikes expected continued to rise to the point where by the end of February, many predicted that there might be as many as 6 to 7 rate hikes in the coming year. And the chart on the right, you can see that even at late in February, the likelihood or expectation of even a higher rate hike in March, around as much as 50 basis points, became the most likely expected outcome. However, since the conflict in Russia began, and also as well as some testimony from Chairman Powell in Congress over the last week, it's become more clear, more likely at least, that we're going to see a 25 basis point rate hike in March, and then we'll see where things go from there. And so the challenge we're in right now is rate hikes by themselves, in my opinion, aren't going to be what's going to stop inflation, but typically rate hikes into a slowing economy are more likely to lead to a recession, and it's really the recession that comes out of the back end of the rate hikes that leads to inflation coming back down. And I don't know if that's really the ideal outcome, but there may not be many choices considering how high the level of inflation is right now, and it's becoming politically challenging to see the prices at the pump. Another big area that we're keeping an eye on is disposable income, and also why we have some level of concern about the economy in the near future. If you look at the chart on the left, it is showing the big green bars are the big stimulus payments that came over the last couple of years, and in particular, in January of last year and in March of last year, there were significant stimulus checks that went out. And right now, there's no bills in Congress that are likely to come through anytime soon that have any new stimulus coming through. At the same time, we are seeing that higher levels of inflation that are causing more of people's income to go towards just basic needs, which means we have a lot lower of overall disposable income, which makes it challenging for the economy to continue to grow. So all of those things, put together, create some challenging numbers, some concerning numbers on how much growth we can really squeeze out of this economy going forward. Another key piece to the overall economy is housing. And so what we see here is a couple of charts related to that. The first one on the left is showing the current 30-year mortgage rate. And what we've seen in 2022 is a bit of a spike up to about 4% on that chart. And if you look at the one on the right, it's the median days that homes have been on the market. And what you've seen over the last 10 years is a significant drop in the number of days that homes stay on the market. But also, if you look at the two charts together, they kind of follow relatively closely. As we've seen a drop in rates, so have we seen a drop in the number of days in the market. So it'll be interesting to watch this chart on the right over the coming months to see if this rise in rates starts to impact the affordability of housing and how long homes stay on the market, and maybe to a positive, might lead to higher supply, which leads to a little bit more choice for people buying. But what we're starting to see is between inflation, rising rates, might put a little bit of a damper on the housing market, at least in the near term. So as a conclusion, to at least what we're seeing in February and right now, challenging markets. Things have changed a lot since we first put out our first video of the year in terms of where we thought things would be heading. We did predict that we'd be seeing some challenging times ahead, maybe by Q2, with GDP slowing and interest rates potentially coming down. Obviously, we couldn't predict and anticipate a major conflict in Europe with Ukraine and Russia, which has only accelerated some of the challenging numbers that we're seeing out there. And with higher oil prices and higher inflation overall, all of that combined leads us to believe we've got more challenging times ahead and more volatility ahead, which really brings home our all-weather approach and philosophy around investing, and the idea that you need to have a good defense combined with a good offense, and make sure you have components in your portfolio that can be a good ballast when the economic data is creating and just geopolitical concerns are creating challenging market times. So having the potential in your portfolio to have things like commodity trend that does well in an inflationary period, having things every now and then, even like gold, which a lot of people look at as more of a doomsday asset, but there are times in a portfolio where gold can be really additive to the overall performance. And other classes like long volatility that we've spoken to in previous videos as well. So those pieces are providing, again, good defense right now at a time when it's needed the most. So if you have any questions about your portfolio, or you're interested in learning more about our approach to investing, we'd love to hear from you. Go ahead and send me an email at homer@convergentwealth.com. We'd be happy to talk with you about everything going on in the world politically and economically right now, and just take a look at your portfolio and see if there might be some adjustments that could be made. So with that, thank you very much for watching, and we'll talk to you soon.